So hello students, on today's video we are going to study about the golden rules of accounting. It's the most important rule in accountancy and in accounting career. So every students must know what are these golden rules. So before going to the section, I'd like to introduce myself. I Kevin Bijoy. Then okay, we'll go to the session. And before going to the golden rules, first we can study from the basics. So the basic is that classification of account. So how can be accounts classified? Classification of accounts. So the question is that how can the accounts be classified? And the answer is it can be classified into two. One is traditional classification and second is modern classification. So there are two types of classification, traditional and modern. These are the basic. Must be attentive here. Don't skip the video. Watch the full video. So here it's a basic that traditional and modern types of account are prepared. In tradition, there are two classifications. One is personal and the other is impersonal. So we studied that classification of accounts. There are two types of classification, traditional and modern classification. Under traditional, personal and impersonal accounts are prepared. So the golden rules of accounting comes under the traditional account, under the traditional account. So personal account means it's related to like a person, that is an individual, company, debtor, creditor, anything. These types of groups of people are called personal account. These types of account are called personal account. And in personal account, the first golden rule of personal account. So attentive here, be attentive. Personal account. The first golden rule is debit receiver, credit the giver. Simple. So the first golden rule is debit the receiver, credit the giver. So the first golden rule of personal account is debit the receiver and credit the giver. Okay, I will say an example. Example, Arun, and my name is Kevin. Arun is selling some app, and I am receiving, and I need to buy that apple. So in if I need to buy that apple, I need to give money. So Arjun will give me the apple. In place of that apple, I will give him money back to him. So who receives here? I receive the apple and credit the giver. Debit the receiver and credit the giver. When personal account is prepared, debit is the receiver and credit is the giver. And I think that the concept is clear. Mm, If you have any further doubts, you can comment in the comment box. I'll give the explanation, and otherwise you can just watch the video again. So now next, second account is the impersonal account. So here real and nominal account is prepared. This is the basic of this is a classification of impersonal account. So impersonal account is classified as real and nominal account. Next, real account means which relate to tangible and intangible assets. Tangible and intangible assets. Tangible means which can be touched or feel, and intangible means we cannot see it. That types of assets are called intangible assets. So in real account, the rule of real account is that here second I'll put. So because first is a personal account and second the real account. It can be classified as debit, what comes in, credit, what goes out. Debit, what comes in, and credit, what goes out. This is the basic of real account. So whatever comes in, where example I said that real account, this is the entry of real account. So just make it clear, real account. Okay. So whatever comes in, example I said that real account means tangible and intangible forces. So tangible means the assets and liability. Assets I said that's what comes in. If I am a company and I'm purchasing a machinery, what comes in? The machinery comes in, and what goes out? The money goes out. That is the entry, nominal account. So, and what's the rule? It's debit all expense, credit all income. I think it's clear. Debit all expense, credit all income. The concept is easy. This is the most easiest concept and the most basic fundamental of accounting. You must know this wherever you go. So debit all expense and credit all whatever comes in should be whatever or expenses are created should be shown debit side and all income should be shown the credit side. Debit means the left side and credit means the right side. I think the concept is clear. Study in the next topic on the next video, and I think this video is useful for you all and need your support and encouragement and give your feedback on a comment section and do the best and leave the rest. Thank you. Kevin Bijoy signing off.